China just triggered the one financial move Washington feared most. It quietly dumped billions in U.S. Treasuries, without a warning, without a press release. The result? Markets trembled, bond yields spiked, and inside the White House, Trump erupted. This wasn't a trade dispute. It was a direct hit to America's financial core. And within hours, Trump fired back, announcing a sweeping 50% tariff on all BRICS imports, sending shockwaves through global supply chains. For decades, U.S. debt was untouchable, a pillar of stability. But now, the largest foreign holders are walking away, and the consequences could reshape the global order. What happens when the world stops buying America's debt? It didn't happen overnight. This move was months in the making. Behind closed doors in Beijing, China's top economic planners had been quietly unloading U.S. Treasuries since March, not in panic, but with precision. Their goal? Reduce dependency on the dollar, weaponize America's own debt, and shift leverage to the East. What set it off? A trifecta of pressure. First, the U.S. Federal Reserve announced it would hold interest rates higher for longer, driving down the value of older bonds China already held. Second, Washington escalated sanctions on Chinese tech firms, freezing billions in overseas assets. To Beijing, that crossed the line. Their financial response? Silent and deadly. And third, Trump returned. With his aggressive stance on trade, renewed tariff threats, and public calls for economic decoupling, China saw the writing on the wall. Holding U.S. debt no longer made strategic sense. So they started dumping. In May alone, China offloaded $57 billion, 0 cents, in U.S. Treasuries, the single largest one-month decline in over a decade, according to Treasury data, and, insiders say, it's just the beginning. This wasn't economic policy, it was economic retaliation. And now, the U.S. bond market is bleeding, and global confidence is cracking. The bond market felt it first. As China's sell-off accelerated, yields on 10-year U.S. Treasuries surged past 5.2%, the highest level since 2007. That spike wasn't normal. It was a warning. Higher yields mean higher borrowing costs, not just for Washington, but for every American, mortgage, credit card, and business loan. Wall Street scrambled. Banks began dumping their own bonds to stem losses. Pension funds rebalanced. Foreign buyers pulled out of auctions. A $42 billion 0 cents Treasury sale failed to clear, forcing the Fed to step in quietly and absorb the excess. It was déjà vu from a crisis no one was prepared for. Meanwhile, the Dow plunged over 900 points in 2 days. Bond volatility hit levels not seen since the 2020 pandemic crash. And behind the scenes, Fed Chair Jerome Powell entered emergency meetings. Caught between inflation fears and a collapsing debt market, Trump blamed everyone. China, the Fed, even his own Treasury Secretary. But the truth was simpler. The U.S. had grown addicted to cheap borrowing. And now the dealer, China, was walking away. The financial system cracked. Not with a bang, but with a sell-off. And that was just the start. Trump doesn't wait for consensus, he strikes. Just 36 hours after China's Treasury dump rattled global markets, Trump took the podium at a hastily arranged press conference. His message was clear and explosive. Effective immediately, a 50% tariff will be placed on all goods imported from BRICS nations. The announcement sent shockwaves through every trading floor on Earth. BRICS, Brazil, Russia, India, China, South Africa, collectively represent over $4 trillion, 0 cents, in U.S. import volume. Slamming a 50% tax on those goods doesn't just hurt them, it inflames inflation at home. But Trump didn't flinch. "This is economic war," he declared. "They hit our debt, we hit their trade." Within minutes, retaliation began. China suspended all agricultural purchases. India halted semiconductor deals. Brazil announced an emergency trade summit. The South African rand collapsed. Russia? It cheered. Knowing the chaos played perfectly into its long-term goals. Behind closed doors, U.S. corporations were in panic mode. Apple? Tesla? Amazon? Supply chains shattered. The Chamber of Commerce called it an unforced economic catastrophe. Trump didn't care. For him, this was personal. A full-blown trade war wasn't collateral, it was the strategy. And now, the global economy was caught in the crossfire. The financial fallout was immediate and brutal. Global investors began dumping U.S. debt, fearing more sell-offs from China and BRICS nations. Foreign participation in Treasury auctions dropped by 31%, the steepest collapse since 2008. With fewer buyers, yields exploded. 10-year bonds hit 5.8%, and 30-year mortgages surged past 8.1%. The cost of borrowing? Skyrocketing. Washington's interest payments ballooned. According to Moody's, the annual interest on U.S. debt is now projected to exceed $1,400 billion, 0 cents, more than the entire defense budget. Meanwhile, credit agencies began quietly warning about a potential U.S. downgrade, citing political instability and retaliatory economic policies. Wall Street bled. The S&P dropped 6% in a week. The Nasdaq lost $1,100 billion. 0 cents in tech value alone. Gold soared. Bitcoin surged. Safe havens were being redefined. Consumer confidence nosedived. Major retailers like Walmart and Target warned of import shortages and price spikes. Automakers delayed launches. Layoffs began. First in logistics, then manufacturing. From Congo, the dollar, once the bedrock of global finance, started to crack under its own weight. And through it all, Trump doubled down. "America first," he repeated. But, to the markets, it sounded more like America alone. This wasn't just economic turbulence. It was a full-blown confidence crisis. While the U.S. scrambled, BRICS moved with precision. Within days of Trump's 50% tariff order, the BRICS alliance announced an emergency summit. Not in New York or Geneva, but in Johannesburg. The message was clear. The West is no longer the center of global trade. China led the charge, proposing a BRICS reserve fund to stabilize member economies hit by U.S. sanctions. India signed a multi-billion-dollar trade pact with Brazil, settled entirely in rupees and reals. Russia accelerated oil shipments to China and South Africa using digital yuan. For the first time ever, BRICS publicly floated the idea of a joint currency backed by gold, rare earths, and energy. Not a theoretical idea, an actionable roadmap. The IMF called it a real threat to dollar dominance. Meanwhile, U.S. allies watched nervously. Indonesia, Turkey, and even Saudi Arabia expressed interest in joining the BRICS bloc. What was once an informal group is now an economic counterforce, flexing its independence. The tariffs didn't divide BRICS, they unified them. And as Washington's leverage fades, the rest of the world is quietly learning one thing. You don't need the dollar to defy the United States. So now the world is asking, who's really in charge? For decades, U.S. Treasuries were untouchable. BRICS were fragmented. Trade wars were political theater. But that era just ended. China pulled the trigger. BRICS held the line. And Trump's retaliation may have pushed the global economy into uncharted territory. America still prints the world's reserve currency. But what happens when no one wants to hold it? This isn't just a debt sell-off. It's a warning shot from a rising bloc that no longer fears U.S. pressure. And from here, every move Washington makes will be watched, measured, and countered. A 50% tariff may look like strength, but global markets saw something else. Desperation. So the real question isn't what happens next. It's who breaks first. The U.S. system holding $37 trillion, 0 cents in debt, or the global order trying to escape it. The game has changed, and the next move is already in play.